The most referenced blog on how to invest for financial independence is the Stock Series, written by Jim Collins on a blog called jlcollinsnh.com. The blog posts have recently been revamped into a book called The Simple Path to Wealth, and this is now probably the most referenced investing book within the financial independence community. Some even call it the greatest personal finance book ever written. The concepts in this book are very simple and clearly draw the roadmap to financial independence. The simple path to wealth involves two phases: an accumulation phase, where you are building wealth, and a preservation phase, where you are living off of your portfolio. During the accumulation phase, you invest 100% in a stock index. During the preservation phase, you switch to 75% stocks, 20% bonds, and 5% cash, and draw down at a rate of around 4% a year to cover your expenses. So let's break this down. Firstly, the wealth accumulation phase. The wealth accumulation phase is when you are working, have a long time horizon, and are investing money consistently each month. If the market drops, then you continue to buy shares at lower prices. This is the time to take risk and try to generate high returns by investing 100% in stocks. Can't tolerate the rough ride of stocks? Jim says, toughen up, cupcake. Jim recommends investing passively in low-cost, broad-based index funds, such as the Vanguard Total Stock Market Index Fund, referred to as VTSAX. This fund consists of virtually every publicly traded company in the US. People living outside of the US, such as myself, should invest in a global stock market index that consists of most of the companies globally. An example of this for a UK investor would be the Vanguard FTSE Global All Cap Index Fund. So why invest passively in an index? The odds of selecting stocks that outperform the index are small. Jim says he can't pick winning stocks, and the chances are, unless your name is Warren Buffett, then you can't either. Actively managed funds are not much better, and when you factor in management costs, the chances of outperforming an index get even smaller. Therefore, simple is good, simple is easy, and simple is more profitable. Stick to low-cost, broad-based index funds. Next, let's look at the wealth preservation phase. You move into the wealth preservation phase when you have reached financial independence. At this point, you have enough invested in your portfolio to stop working and can live purely off of your investments. Typically, this is the case when your investments are around 25 times your annual expenses. At this point, you start living off your portfolio, so you need a smoother ride, i.e., you should switch into some lower risk assets. 20% of your portfolio now goes into bonds. Bonds provide income and tend to smooth out the rough ride of stocks. They also provide a deflation hedge. Jim recommends the Vanguard Total Bond Market Index Fund, VBTLX. For a UK investor, this fund could be replaced by something like the Vanguard Global Bond Index Fund or the UK Government Bond Index Fund. 5% of your portfolio goes into cash. Cash is included in the portfolio to cover any short-term expenses or emergencies to prevent a forced sale of investments in a market downturn. This can be kept in a high-yield savings account or money market fund. And that is an overview of the simple path to wealth. I told you it's simple. Save more and you reach financial independence sooner. Save less and you get there later. Jim says to save at least 50% of your income each month, but the principles work no matter how much you save. Stick to the simple path and get on with living your life.